Fisker. We have a question this morning from one of our members. What do you do with Fisker if you are down so much? So we're going to answer that question, and it might help a number of you as well. So here we go. And many people are in this position. Buckaroony has just asked me about Fisker. I just don't know what to do about this Fisker. Currently 13,000 down on it. It's hard to click that sell button at a huge loss. What would you do in my situation? Now, to add some context to that, Buckaroony has added another comment, and he says, I'm not bragging, but my company earns me a very, very good wage. So I can afford to leave it and lose it. I have 89,000 shares at a 49 cents average. So let's discuss what should Buckaroony do, or what should you do? Whether you've got $10, $1,000, $1 million, or whatever it might be invested in any company, I think this same situation applies. If you are down on a stock, first of all, we need to remember you are not down on anything until you sell. All that's happened is the value of the shares that you own for that company have gone down in price. The company, however, could be going up in value. It could be doing great things. So there could be great things on the horizon. However, should you sell if you're down and you think it's going to continue to go down? Well, I've had this experience many, many times, and I've had it a lot with Virgin Galactic. Over the years, I must have lost somewhere in the region of $30,000. But there are a couple of things to say with this. People use the phrase a lot on YouTube. Only invest what you can afford to lose. So if you can afford to lose it, doesn't matter. Get out, sell for a loss. It's okay. I don't agree with any of that. It makes great thumbnails and great clickbait and great uneducated headlines, but actually I don't agree with any of that. You shouldn't ever consider it an option to lose money, or it's okay to lose money. Respect the money. You shouldn't just be happy with the fact it's okay to lose money because you have a good wage, or you earn good money, or it doesn't really matter. It does matter, because if you consistently make profits, even if they're small, you're going to do much better than if you win big and lose big. More often than not, you'll lose big, and particularly if you sell. Now then, so is it right to sell when you're down? Now, some people will tell you, again, makes great video content on YouTube. They'll say, for example, if you sell when you're down, then you can write that off against tax. Well, it makes a good headline, looks good on a YouTube channel, but again, it's not the full story. There's more to it than that. And let's discuss that now. If you buy a stock on your IRA, or as it is in America, Roth or traditional, or in the UK, it would be an ISA, individual savings account, you are trading tax-free. So if you make gains, if you sell, you hold, whatever, and you sell, you pay no tax. If, on the other hand, you sell for a loss, you do not get any benefit from a tax loss, because it's a tax-free account. So first of all, if you are doing the transaction through an IRA, Roth or traditional, or an ISA, it doesn't matter, or you don't benefit from selling at a loss, going, well, I've just, written it off and all the rest of it. That's not the case. That doesn't help you at all. You've just got less money now. That's it. Well, if you're trying to get less money for other reasons, well, that's fine. But it didn't benefit you from a tax point of view. However, if you were on your main brokerage account, and this is pretty standard, but I can't comment about tax in every country. I don't know your situation. I'm not even trying to give financial advice. I'm just sharing my experience. If you sell for a loss on a brokerage account, then that can be a tax loss. However, before you sell for a loss, you need to consider what your tax implication would be in the first place. If you earn under the threshold, then maybe you would never pay tax this year anyway. In Buckarooni's case, clearly, obviously, he earns a good wage. He's a taxpayer. So if you have, say, for example, expected a $10,000 tax bill, and it's why it's important to do your taxes and accounts along the journey. I do my accounts every day. I'm up to date with my accounts minute by minute, second by second. Every time I buy something, it's accounted. I know what my tax liability is going to be at any given moment throughout the year. So I know at the end of the year, I've got a tax bill of, say, $10,000. I know that. So if I sell something and I lose $10,000, does that mean I don't get a tax bill? No, it doesn't mean because you owe $10,000 and you've now lost $10,000, you're going to get zero tax. It's a loss, and it gets offset as an expense, a loss against your tax. Depending on your tax rate and your individual situation, there'll be a discount off the $10,000. It doesn't necessarily wipe that out. You need to speak to your CPA or your accountant, as it is in England. CPA is what it is in America. So you need to find out and speak with your accounts and tax specialist to find out, if I had a $10,000 bill and I lost $10,000, how much discount would I get? And the answer would be specific to you, depending on your threshold, your tax situation, and so on and so forth. So it's not black and white. So you need to consider that. So don't just sell because it's okay, I'm down because I earn good money, and the phrase of I can sell, I can sell at some point. That's okay. Don't invest what you can't afford to lose. That's not a standard you should abide by. That will always lead to losses. So don't consider that option. The option of a tax loss only works and only applies on your brokerage account, and you need to check your tax situation before you do. There's one other element to this. If a stock goes down, you've got to ask yourself a couple of questions. Did you enter it in the right way? What I mean by that is when you decided to buy a stock, was you buying it with emotion and excitement, or was you buying it with completely structured strategy? What I mean by that is, and this is important to explain this because this will explain the exit. If you decided to buy Fisker, you liked Fisker. You didn't buy it because of something I said on YouTube. You didn't buy it because of someone you heard on Reddit or anywhere else. You bought it because perhaps you've heard about it through my show or other sources. You've looked at my analysis reviews. You've also then read those reviews. You've also read the balance sheet. You've also looked at the debt position, but you've also looked at the prospectus. You've looked at the potential for the business. At the end of the day, you invest in a company at a price because you believe that is undervalued, and in the future, that business is going to be bigger than it is today, thereby reflecting the stock price. Not immediately. A company can go up, do well on earnings, but the stock price might go down. It sometimes takes a while for the stock price to reflect the progress of the company. But nevertheless, you decided to buy Fisker or any other stock, but we are focused on Fisker right now. So you decided it was a good company. You believe where the price is at the moment you pulled the pin and you decided to buy it, it was a good buy. It was undervalued at that moment in time. So what you should do is you've looked at your portfolio, the balance of your portfolio. You know your objectives. You know your tax position. You know your goals. You know what you're trying to achieve, and you know your emotional stability and your intelligence and how you conduct business. You know that. So you decide that I want to buy Fisker at this price. What is my allocation? People jump into buying a stock and then just find themselves dollar cost averaging because they hear that on YouTube a lot, particularly in the crypto world. That doesn't work. It doesn't work because we don't all have infinite amount of money to keep buying lower and higher and all the rest of it. We need a strategy. Before a general launches an attack on its enemy, it knows its next move. A great chess player knows its next 5 to 7 moves. I'm the same. I look at chess as the same way as investing on the stock market. I'm 7 moves ahead. If you're just making one move, you're going to always lose. Because the competition, which is the market, is moving hundreds of moves ahead. So you're going to always lose statistically. So you decided to buy it. You know your goals. You know your tax implications. You know your overall structure. You know who you are. You now have to have a balanced portfolio. It's no good just being all in on one stock. That is very, very extremely risky unless you are the greatest trader in the history of the world and you know what's going to happen and you have a crystal ball. Even if you believe in the company and think it's the greatest company in the world, you don't know how the market is going to treat that stock. You don't know if there's going to be extra external conditions. You don't know if there's going to be macro conditions, wars. You don't know if there's going to be supply shortages. You cannot know. Nobody knows. So you have to have a balanced portfolio. So you then decide, right, I have got $10,000 to invest in total for my total portfolio. That's what I've got. So I decide what is the risk of Fisker, and I will give it a risk score. I will say it's 90% likely to be successful. In my mind, I have a strategy. I have a structure. Doesn't mean it's going to be right, but I have a belief. I have some kind of plan. So I decide it's a 90% risky stock. It's very risky. It's maybe extremely likely to fail. So why would I buy it? Well, I still believe there's a good potential. Like buying a lottery ticket, I buy a lottery ticket, not expecting not to win. So I don't put all my money on a lottery ticket. I'll buy $1 of a lottery ticket. So I've given it a risk score in my head and I've given myself an allocation. So let's say out of my $10,000, I have given it a high risk but the risk to reward is good. So I want to be in, but I'm going to give it a 90% chance of failure. So I'm going to maybe spend 10% of my money. 90% is going to be left for something else. So that allows me $900 out of my $10,000. $100 out of my 1,000. So I believe it's got a good risk to reward, but I'm going to keep I'm going to keep the 9,000 for the S&P or whatever, but I'm going to invest 1,000. So now I've got $1,000 to spend on Fisker. All of these steps have happened. I didn't just buy it. All of these steps have happened. Now I'm looking at Fisker and going, right, I've got $1,000. I've still got my $9,000 over here for other things because I've given it that risk level. $9,000. Now I don't know if the stock's going to go up, down, left, or sideways. But I like it where it is. I've already decided I'm happy to buy it. I then look at it and I look at the likelihood of it going down further. We don't know. Could it go down further? It can go down forever. We could keep being reverse split and it could go on forever and ever and ever and ever. There's never a bottom until it's over. Okay, so I decide, well, it's been continually trending down. The chance of it suddenly going up the other way are less likely because it's been continually trending down. So what I'm going to do, because I don't know the answer to what's going to happen next, is I'll put $500 of my $1,000 in. That's it. Not the 9,000, not get excited, not bring more in, not change my plan, not suddenly go all over the place. $500. I've got $500 on the side ready to buy more. Ready to buy more if it goes down further. What if it goes up? Doesn't matter. My structure is in place. I know what the risk is. If it goes up, that's fine. Maybe I trim off a little bit. If it makes more than 15%, which is more than the S&P will make in a year, in a day or so, as long as that's been done on my tax-free account, I will trim it because I've made a profit. Others will trim it, it will drop lower, and then I can start dollar cost averaging with the remainder of my $500. Maybe I'll go another 200, but I've still got 300 left. The 300 left now is waiting for a further dip. And that is how I get into the stock. Now, the question was, how should I get out of the stock from Buckaroo, remember, at the beginning of the video? But it's important to understand how you got in with the structure and the plan to how you get out. So it's like playing chess. You're not going to be reactionary. You're going to be proactive. You're going to assume what's going to happen next. It's like years ago, I learned to be an advanced motorcyclist. I trained with the RAF, Royal Air Force Outrider, and I learned to read the road of what would happen if everybody else on the road does something. So I am prepared ahead of time. Not when they do something, now I do something. I'm already doing something in my mind, assuming they're going to do something. I'm ready for them to react. The stock market is exactly the same. So it was important to explain the brokerage and the Roth, the IRA and the tax and the strategy of initially getting in the stock and the strategy to actually implementing the transaction to getting in on the stock to be able to answer the question of how to get out. So now we fully understand our position, we're probably in a better position understanding of how to get out. So if we are down right now and we did our risk factor and we liked it, we have money on hand to buy more to lower our average. We've always kept that little bit of money to buy lower. Now, if it goes even lower, do you buy even more? No, if it messes up your original plan. Now, perhaps you've earned some more money since your original plan and you can bring new, fresh money in. But your original plan and structure shouldn't change about the risk and so on and so forth. You shouldn't just throw that out, because if it goes down and continues to go down, people on YouTube will say, hey, dollar cost average, keep learning your average. Not forever, you shouldn't, because the stock may very well be going to zero. You've already decided your plan and structure, stick to it. That way you feel confident and you're not going to make any rash decisions. So, concluding this video, I'm down. It's hard to click the sell button. There's one final piece I want to add to this. And I'm sorry, I make no apologies for this long answer, because it is a complex answer. It's not straightforward and simple. So I'm going to finish with this. This is important. Buckaroo was asking about selling. I have done this firsthand with Virgin Galactic. So take everything I've said in thought, into context, and now, are you going to sell for a loss, even if it doesn't affect your tax? Now, you're not doing it for tax reasons. You're not doing it to lower from one tax bracket to another. Maybe you've gone over a certain tax bracket. You've gone to 50% tax. You want to drop back to 20% or 40%. So you want to lower the tax by lowering your overall profit that year. It's not that reason. That's not what you're doing it for. You've got no tax, you're rich, you've got loads of money, you don't care, whatever reason, all right? You're looking at it simply, is there another reason why it would be good to sell? And yes, it is. And I'm going to answer that now. If the stock, you bought the stock at, say, 40, I believe Buckaroo bought it at 49, and it's now 34. And he's not looking to sell it for tax reasons. He's not interested in that. He doesn't need a tax write-off. He's not paying tax anyway, or whatever reason. He is concerned that he's down. He doesn't want to lose any more money. You need to ask yourself this. If you bought it at 49 and it's now at 34 and you're considering selling, are you considering selling because you think the business model has changed, it's failed, it's not achieving its goals, it's not going to maintain this price, it's not going to return a profit, and it's down? Then of course it's right to sell because you get some money out. Better to get something out than nothing. At least you've got some money back and you do have a write-off, and if you've done it correctly and so on and so forth, right? But there's one other piece to this. What if you think the business is still good and you still want to be in it, but you want to reduce your losses? Well, you can't make the price go up because the price is where it is. The price is down, you've lost money. Now, I've done this several times and got myself out of a stock and actually got back my money. This is what I have done in the past many, many, many times. I bought at 49. I'm using Buckaroo now as an example. I bought at 49. I'm not selling for tax reasons. It's now down at 34. I like the company, but I think it's being oversold. I believe it's having a short attack. I believe there is short-term bad news, but good news is coming. I want the stock. I've got two choices. I'm not adding any more money because that would upset my balance. I would either do absolutely nothing and wait for it to go up, make a profit. Maybe I get out at that point, or I'm just on my original path of it going to $10 or whatever I set that target. That could be one option. Option two could be this. I still believe it's going lower. I believe it's going to go to 20 cents now. I can sell what I have at 34 cents, keep the cash on hand, and buy it all back at 20 cents. You're in a much better position. Much, much better position if you do that. And I've done that on many, many occasions, and that has saved me. So let me make it like a visual. You start from here. It drops to here. Your stocks have devalued. You haven't lost any money until you sell. We're not looking at tax. We're not looking at tax write-offs. The value has gone down. You haven't lost any money. But you decide to sell here because you know it's going to here. If you did nothing and it went from here to here, you've now got this value. You've got the same many shares. You haven't gained anything. You're just worth less, even less now than you were at here. However, if you sold here, disregarding tax incentives and benefits, you sold here because you believe it's going to here.
Great information. Everything you have said I have done. I know I have enough Fisker. Bought 4 times on the dip. It's hard to not buy more when you have extra cash available. Him not selling.
Thank you very much for the super chat, and thank you very much for the comment. As I said, if you are here and you sell here, you wait for a 10% drop and you buy it back with the money that you have. If you want to bring tax into it, you've got to wait 30 days for a wash sale. So you've got to wait 31 days if you're going to post that as a tax loss. But if that's not the reason, you can do it the same minute. You sell here, you buy back here, you've now got more shares. Because the money you had here, let's say you had, 1 share here, and it drops here, you can now buy 2 shares here. Whereas if you'd gone from there and then fell to there, literally fell to there, you've still got the 1 share. If you were here and you sold here and bought here, you may have more shares now. You've improved your position. Even though you're still down, you've improved it from here. So there is a very long but detailed answer in the entire structure of the question and the answer. And it's important because on YouTube particularly, people will make headline videos of how to get rich, dollar cost average, buy the dip, sell for a loss, don't buy what you can't afford to lose. These are all very simple comic book style, entry level, basic principles designed to do nothing more than to excite the audience and sell a video. None of that information is useful. It's completely and utterly useless. The only benefit is to a creator on YouTube who gets you to watch and earns money from your content, from you watching. It's a much more detailed structure. This is not checkers. This is chess. Chess is a completely different game. So there is a complete answer. You need to start with a structure. You need to know yourself. You need to know your budget, your plan, your portfolio balance. Before you buy, what's your target? What's your exit? What if? What do I do in every situation? You have that. You keep calm. You keep stress-free. You stick to the plan. You get to your goals. You're a happy camper. That's it. That was a full, complete answer to Buckaroony. Thank you very much for your $20 super chat. I appreciate that support. I'm glad you like the information, and I hope that helps you make an informed decision. But at the end of the day, whatever decision you make, it's a best guess for everyone, as it is for you and everybody else. No one knows what's going to happen tomorrow. Whatever decision that you make, if it's balanced and it's well thought out and structured, statistically, overall, you will win. And that's all that matters. But sometimes it'll be the right answer and sometimes it'll be the wrong answer. But at least it will be the right answer more often than it's the wrong answer. But at the end of the day, don't congratulate yourself too much if you get it right. And don't be too down on yourself if you get it wrong. Because everybody else has the same chance of getting it right as you. It can go up, it can go down. Nobody knows. But by applying these steps, you increase your chances tenfold. Just because you're tenfold, though, doesn't mean you're going to win or lose. It just makes you feel better and understands your position. Click above my head for all the information. Click below in the description. Over here and over here for more videos. That was a long answer to a very important question. Buckaroony, thank you very much indeed. Until next time, as always, take care of yourselves and each other.